The broadcast is now starting. All attendees are in listen-only mode.
Hello, Face Warriors. Let's have a great week. Everyone doing okay? I hope I selected the right webinar to do, Steve. It looked like the order was changed on the page. Anyway, it looks okay. So this could be a pretty important week in the dollar and the euro. I really think if we start closing above 113.80, 114, the picture's changing and we'll attack these highs and take it out. So a significant week in all the currencies, in my view. 1380, I will attempt a sale and go with the trend, knowing I'm wrong on closes back over 14 or so. So that's my view. You could see it again here in the Dixie. You know, we're approaching this line 96. The reason that I'm willing to be flexible is I want to see the DSI, but I was talking to Jim Walsh, and he's going to be our guest today. I talk to Jim every once in a while. Used to talk to him, I don't know how many times a day in the day. And he pointed out to me a sentiment and just so many dollar bulls that he's actually looking for 94, like a 118 euro. So, you know, he's another guy, respect his opinion. Also, as a subscriber, you're going to get views and opinions of some of the best traders on the net, on the globe. In fact, my trading warrior brothers and sisters, the Big Apple is buzzing about the international team arriving from ForexAnalytix, representing Greece, Slovenia, and the U.S. So I think Michael Bloomberg is going to meet them and welcome them. And not sure if there's going to be a ticker tape parade, but definitely the Big Apple is buzzing about the arrival of ForexAnalytix to the Money Show. And, you know, when you talk about the euro, Jim is a great intelligence source for me. But, you know, you can't find better on the line, online anywhere than right here. Okay. And you could get, well, what's Greg looking for here? Oh, here's a 4 hour. So see if he's looking for, this is count number 2. It looked like about 114 and maybe I guess down here for a potential end to this. So we'll see. And, you know, if you're not a fan of Elliott, you know, you could always go to Andre's artwork, right? Here's a 4 hour. And Andre looks like this is still in play down to 1260. And, you know, if Blake isn't around, you're going to know what he's thinking on basic technical, right? So I know, you know, Blake is looking at a similar thing, looking at 113.90 as being a critical area. So I'm a big believer in intelligence gathering, okay, and surrounding yourself with traders that are better than you or at least equal to your level, so that you have a lot of great input before you click your mouse. And there's so much confluence at times between the guys and the gals, let alone what happens in the member chat room with Amanda in there and all the other community members masterminding all day, even during FACE, they're doing it, and then all day long into the evening. And Paulie says that there are people there for Europe and Asia. And hope everyone's enjoying Paulie's European crossover to get you prepped for the U.S. session. Paulie gives you important, significant technical areas for you to scalp against. So say, you know, you want to know what Volge's thinking here. Go to Candlestick and let's see what Volge's saying here. Yeah, look, he's got a line down there towards 109. So I would say that the majority opinion of ForexAnalytix is lower first, which, you know, makes me, should we get up there, towards 1380 or so. I may attempt to short. So that's a look in the Dixie. Something else I wanted to point out was, with all this risk on, and S&Ps are blowing again. I believe that they've I don't know if they've extended the deadline, but China came out with some news that there's a lot of progress. But I look at US dollar yen, and it's really not. We're actually putting in lower highs while the S&Ps are blowing off, right? Blowing off with divergence, but blowing off. The boy who cried wolf is saying that the S&Ps are going to top this week with an outside week down, so it's not going to take much. And NASDAQ, very interesting confluence at the 7,000 level. So that was last week's low, right around there, 69.99. So we're starting off higher. So you also have the 50 week here, and you also have the 61.8 level. So right down NASDAQ 100, 7,000, and you start seeing prints underneath it. I think it'll be a pretty good indication that this rally is terminating for some type of correction. So you guys do not have to agree with me, but want to make sure you understand it. Everyone with me understand the technical rationale for the things that I've been saying today. And then I'll wrap it with crude oil. One of my eagles said I must be friends with Donald Trump because, been playing this megaphone top formation here. Well, it's already starting out to be a pretty negative week, but here's your megaphone. Someone on Twitter said it's not a megaphone. It's a retest of an ascending triangle. So they're using this line right here. And this is something that we talked about last week. Blake said last week, we take out these lows, which is what it held Thursday. That would be the first sign that there's some problems. And this is really, this is going to negate people. I think Blake was showing the head and shoulders bottom formation, and I think this was a breakout, Blake. So we're in the on the verge of negating that breakout too. So you could call it an ascending triangle, head and shoulders breakout. We're on the verge of a breakout failure. So I have confidence all the way down here at $48. I'm not saying it's going to get there, but definitely off to a very poor start if you're long, great start if you're short. We'll see how the market could hold up if crude's going to break down and head back down towards these, 51 levels or so. So I'm thinking, and I'm not an Elliotician, but this was like a $4.50 break. And so, it's just, it's probably wrong. I'm pretty self-taught, but okay, sure. So 1.618 of this is $7. So 7 from 740 is a little under 50. And the bottom megaphone line comes in at 61.8 at 48.05. And, if we do that, I wouldn't say it's the end of this bull market. Maybe this is where we pull back to before we launch another move into the 60s and shake out some of the bullish sentiment. I think the DSI was in the 90s last week. So let's see, I'm getting some messages. Whoops, I'll move that over. Blake is not available. You're here?
I'm here. I'm here. Yeah.
Oh, okay.
Yeah.
It breaks my train of thought when I get Skypes.
You gotta log out before you start.
But then how do I communicate with you guys? Telepathically?
Talk to us through.
Oh yeah. What a great.
All you have to do is talk.
All right, but I don't know what you're saying. Anyway, how you doing, bro? You
Good.
recovered?
Yeah,
Yeah,
it was snowing here over the weekend.
I know,
I,
man.
I'm in
I saw
Phoenix,
that
Arizona.
picture.
And yeah, it's pretty wild. I mean, we don't get. I've been here pretty much my whole life, and it snowed from time to time. But man, it doesn't happen often. So
Yeah, well, that's why I brought on that guy to interview the new ice age. There,
yeah.
the people are, people just a counter argument to global warming, but
Well, I
uh,
I Ronnie, who you interviewed, Ronnie Schlapfer, he traveled to Antarctica last month. It was on him, his and his wife's bucket list of places to do, and it's pretty amazing, like the amount of ice melting there. So that's it's definitely, I would say, warming and causing change. So
yeah,
the what we're witnessing here is the ramifications of global warming, in my opinion, and we're getting some severe changes in different parts of the world.
yeah.
And
You're going to have oceanfront property in Scottsdale
I
in about
might.
10 years.
Yeah, and you never know. But
Did you close on the other house and take care of the other aggravation?
oh, I'm still working on it. So yeah, just still working on
Don't you
everything.
hate real estate when you're a trader and all you have to do is click a mouse and all all that stuff you have to go through?
Yes, I do.
Yeah, I
Yeah,
thought so.
I'm not a big, most of the people where I live, they're real estate investors, and it's like one of those things that's very maddening to me going through the whole process. So, um, I'll be happy when it's all over and said and done. So let me get rid of all of this stuff. I just need to move my mail over.
Yeah, I'm curious what you're thinking here in the euro. Was that enough, Blake? Did you fade this pop or
No, I
think?
didn't. I'm a little hesitant about the euro. Actually, the pound's coming under a little bit of pressure here. Theresa May is speaking, so she says leaving EU with the deal on March 29th is within our grasp. She also says delaying Brexit does not deliver a decision or a deal. Those are headlines that are just crossing the wire. So the cable is moving a little bit. Let's go over to the pound as she is speaking. So yeah, you got to be a little careful here. The pound's coming under a little bit of pressure, and no, I did not buy the euro dollar. I think, or I did not short the euro dollar. I'm hesitant about trading the euro right at this moment, and as I pointed out in the week ahead video, the thing about the euro is we're trading at that 38% retracement. We're like just right at it, and so I don't want to. I think you can be short if you want to, and you can put your stops above like 131.80, but in my opinion, it's when it's up here, you got to be a little bit more careful with it. And so I'm a little hesitant on what to do with the euro at this point. The cable is trading pretty firm. I know it's come off just a couple of pips after she spoke, but or as she's speaking. Hold on, let's see. May has said had constructive meeting with EU on Brexit backstop. So no new news, just some updates. But you got to watch the pound here, because if the pound clears a 131 level, we do have a bull flag. So, and it's been resilient. You can't ignore the fact that the pound had a pullback to the 38% retracement. It is stalling. It's bounced. And so if we could get up here, we start trading above 131, you got to think that that's a pretty bullish breakout. So, I think we all need to be watching the cable here, and the cable has been, like I said, relatively resilient. And see, the point that I made during the week ahead video is if the pound does break out, that's going to drag the euro higher too. So that's one of the things that I'm a little hesitant about shorting the euro up here is because the pound is so strong. Let's see. May also says. Urges Parliament to come together to deliver Brexit. Okay. Yada. And so anyway, so just watching the pound, watching the euro. Now the Aussie is really, Aussie is much stronger today. The Aussie is stronger as the market is looking at, tariff delay as China and the U.S. continue to negotiate. So that's helped the Aussie dollar. And I really don't know what to do with the Aussie either. When a deal gets done, I'd said that, and I'm been waiting on this. Whenever a deal gets done, I will start looking for an Aussie short. That's going to be my the way I want to trade a China U.S. deal being done. Now I don't know if when I'll short the Aussie. It'll probably be the same day or the following day after we get some of the, positive developments, once they carry through the market, then I'll start looking for Aussie shorts. But I'm leaving the Aussie alone right now, especially while it's above this support level, while it's above 70 cents. Now, the flip side to that also is that, if the Aussie really gets, a move above, like, let's say, 72.50, which is the 200-day moving average, comes in right around the same spot, then the Aussie looks really constructive. But right now the U.S. China trade negotiations are continuing, so the Aussie is obviously holding in there very well. Kiwi looks relatively strong too. We're in a nice little triangle pattern. We're approaching the upper trend line, which is, at 69 and a quarter. So, got to watch that, as we're only 30, 40 pips away. So it looks relatively buoyant as well. One of the other things I want to mention before I continue on with some of these majors, and I'm going to go through all these majors here, is that we do have Grega Horvat who's coming in. And if you guys don't know who Grega is our provides us with the Elliott wave analysis for ForexAnalytix. He's very talented in his analysis on all instruments. And so hearing his analysis on some of these majors, especially while we're in such tight trading ranges, is going to be really important in my opinion. So you guys got to stick around for that. Now, I know you said you're bringing on Jim Welsh.
Yeah,
he's a great he's really good to listen to. I enjoy listening to Jim. He's one of the guys that I would say that gets it. He gets the market. He has a good understanding of it. So
he started. I forgot what the first title of his newsletter. I've known him for over 20 years. I think 25. But his work was really centered on the Fed. So he has a very good fundamental grasp of things, and then he's a excellent technician to tie it all together. But yeah, I mean, sometimes I read Jim's stuff, and it's so. I send them to you a lot, and his fundamental analysis is great. So one of his big pet peeves, Blake, is that the market's a discounting mechanism. You know how many times you've heard that?
Yeah,
and he shows how many times the market, if it was a discounting mechanism, it got it wrong so many times. So anyway, looking forward to talking to my buddy. Top of the hour.
Yeah, no, that's going to be great. And if you guys have never heard Jim, he's really a wealth of information and such a great interview when you bring him on each and every time. So we've got a lot of good stuff in store for you guys today. So with that being said, let me cover these majors really quick. So regarding the euro, and if you guys didn't see the week ahead video, the volatility in the FX market is at multi-year lows, and that's really tough. It's a tough environment for all of us when the markets are just in very tight trading ranges, trying to make money in, especially the majors. Like if you're trading the euro or if you're trading the yen, it is really, really difficult. So if you guys find yourself struggling, that's the reason why volatility is low. We tend to thrive when volatility is high. And right now, volatility in the FX market is extremely low, and multi-year lows in for a lot of currencies. So like we're getting in the decade lows, and that it doesn't last forever. Dale, you've been around long enough knowing that you may have low volatility for a while, but it'll picks up.
They're blaming it on the lack of volatility in the bond markets. That's why we have low volatility in currencies. That's what they're saying is, they're sideways too. So I don't, I'm not a great fundamentalist, but I'm hearing it attributed to low volatility in bonds is just filtering into everything but equities.
Yeah, I mean that could be it. That really could be a one of the catalysts. Yeah, and one of the factors that's driving us. So anyway, now let's go take a look at the Canadian. So the dollar Canadian, it came off once again following the retail sales. I actually took a 10 pip loss on Friday. I was hoping for it for a weak number. We'd break out to the upside. It didn't. It stopped me out, but the dollar Canadian has come off to the 78% retracement. Now it is firming off the lows, and we've got like this 4-hour candle, nice outside candle. The reason why is because we have weaker crude. Okay, crude oil is weakening because Donald Trump this morning he tweeted about crude oil being too strong. And OPEC's got to be easier on crude, and then crude just took an absolute nosedive. Now, what we've done is we've stopped at this is the big support zone. So just remember, this is the neckline of the big inverted head and shoulder pattern. I've been expecting a move lower. We've talked about the very high daily sentiment index, and it was at risk of pulling back, and here we are pulling back. Friday was a strong day, as typically is for crude oil, and then it reversed this morning, and now we're threatening breaking back down. Now that has helped the dollar Canadian off of the lows. You can see the dollar Canadian down here. I have not given up on the idea that this might be an inverted head and shoulder pattern, but the dollar Canadian would have to move now. I mean, it would have to start making its move like nowish. And I'm not long, so I'm just letting you guys know that this has still has the potential of an inverted head and shoulder pattern. So the dollar Canadian is firming up a little bit. The U.S. dollar Mexican peso is pulling back towards 19. I have some bids. I actually reduced my position size, and I was looking to buy some more down at 19. We didn't quite get down there. We got to 1902, but the dollar Mexican peso is firmed up a little bit. With the fall in crude oil, so that's something to also pay attention to. Dollar Swiss is holding in around this the parity level, not doing a whole lot with that. The U.S. dollar Norwegian krona got a bounce off of support due to this crude oil pullback too. So we're seeing a little firmness with the U.S. dollar Norwegian krona. Matter of fact, I think we should pay a little attention here to a possible wedge developing. Now, this would be a bearish wedge, but if you consider these as same prices, I don't know if I would consider that necessarily the same price, but we might be developing some sort of flag here, or triangle. But anyway, regardless, I think crude or the U.S. dollar Norwegian krona, the U.S. dollar NOK, as people like to refer to it, is the 861, 862 level may offer some decent resistance up there. Let's see. We have, let's take a look at the yen. Now, this is one currency that has been in a really tight trading range. I mean, you can see this 111 to 110.50 until we break out of that range. I'm not touching the dollar yen. I don't even know why that alarm's up there. I'll get rid of it.
EKG of a dead person.
It is really just horrible. I'm going to delete that one. No, we don't need that. It's just really, really tight. Now, again, I've got to point out, as stocks continue to move higher, how the dollar yen hasn't broken out to the upside is beyond me. That is one of the things, and this is where you start looking at yields and saying, okay, well, maybe this is more of a factor of what's happening in the bond market, is what's really containing these yen pairs. But the dollar yen above 111, would be pretty bullish. And if it gets below 110.50, then you have to start looking to the downside. I haven't touched it, and I'm not touching it, but I am, actively looking for some sort of breakout or breakdown. One last thing, we'll go to the dollar index. So the dollar index, it's nearing the 50% retracement. Now, the dollar index had a nice little Gartley pattern. We reversed off of that. We've been retesting this, back testing that broken trend line. Okay. And it's kind of, it's quietly holding above the 50% retracement. So, if we can get, a little bit of a move back above 97, that would, tell us that the dollar index is probably ready for a resumption of trend higher. But the flip side is, if we break below this 50% retracement, we might see a little bit steeper of a sell-off. So that's something that, I'm paying attention to with the dollar index. It's quiet, but it's still, I think there's some possibility that we could get some moves out of here. But, when you look at the market and you look at it, all these majors I just, went through with you guys, the ranges are tight, and, there's a lot of mixed signals, and that doesn't give me any confidence right now as far as trading the majors. Are there opportunities in some of these cross market asset classes or cross market currencies? That's where, a lot of our traders in the ForexAnalytix chat room we've been really focusing our attention is on some of these cross rates. I mean, you look at currencies like, not necessarily the yen pairs, but like if you take a look at, like, let's say the Euro Aussie or the Pound Aussie, these are some currencies that are offering a little bit more volatility. And like, for example, like here's the Pound Aussie. I picked up some Pound Aussie this morning. I bought it because I'm playing this channel. As we approach the 182 level, if we can dip just below 182, I'd prefer to be on the long side. Now, I think you can manage your risk and look for a decent amount of volatility in some of these pairs. I mean, we're seeing, 100, 150 pip, 200 pip moves higher, 100 pip moves lower. You're seeing some volatility here. So, diverting your attention from the majors into some of these cross rates might be a better offer or a better opportunity for some of you guys trading versus the majors. All right. And like, here's the Pound New Zealand. The Pound New Zealand's got some, I mean, these are 300 pip moves. You can see these swings in some of these cross rates. So I think better opportunities might be found away from the majors right now until we start to see a pickup in volatility. And right now you look at the S&P, and Dale, I heard you talking about the S&P. So you think the S&P is actually turning this week. Now, what makes you feel that way? Because I was playing the bearish wedge here and playing it through a dollar yen proxy, and I just took it off the table, even though I still think that the S&P has got a lot of resistance up here. I think it's worth playing to the downside, but at the same time, I'm
the boy who cried wolf.
It's pretty bullish. I mean, it's not.
But I look for how a market starts out for the week, and it could continue to go parabolic, but it's also set up. There's like back under last week's lows would be an outside week, and really, especially in the NASDAQ, there's so much at 7,000 that I think there's a chance of a reversal. Maybe it's a buy the rumor, sell the fact on whatever the China thing is. Maybe it's disappointing, but I think we're over 78.6 back on this retrace, and
we're there,
yeah. So I just think maybe if you're conservative on like NASDAQ or S&Ps, you just wait for last week's lows to be taken out. That would be a pretty good indication that directionally we're changing. But I think there's a shot for an outside week on. I kind of think the China deal's priced in, almost like everything we want. The market's acting like we're going to get it, and I don't know if we'll get everything we want. I think it might be, it might look that way on the surface, but I don't think they're going to come to agreements about, intellectual property and so forth. Anyway, I think the S&Ps should have won Best Actor award for um, posing as a bull market.
well, we definitely have a bull market, and it's making its way, as a pretty good standout. So
I saw this morning, Blake, because you said you loved that Queen movie. You said it was great.
Oh, the show. Yes.
Yeah, the movie.
Wait, the Queen, the Bohemian Rhapsody. Yes.
And the guy from iRobot, and he's getting all kinds of roles, but. Yeah, he fell off the stage after he won the award. Yeah,
he tripped or fell.
Yeah, he tripped, fell. Wow. There were doctors looking at him, and
no kidding.
Yeah.
Wow.
So anyway, Freddie Mercury never fell off a stage. He jumped off a stage. Anyway, I'm just saying that.
Okay. Well, I tell you what, that's probably one of the better actors of our time. That's for sure. So it looks like we might have Stelios joining in. Good morning, Stelios.
Hello. Hey. I just made it. How you doing?
Hey. Good morning, bro.
So Stelios, just an update from you. Like what's happened over the weekend with the China-U.S. Trade negotiations? What's happening there?
Well, there have been some comments that there's been some significant progress. I've actually been away for the past hour or two, so I don't know if there was anything new.
Nothing new. No.
Okay, but really, there's nothing firm yet. But as has been the case recently, the market really likes to take the positive, and equity markets rallying whenever they hear about a progress being made, which is again nothing firm yet, just what people are saying, and then whenever it's been denied or or something else is said, the equity markets actually just stay with take the gains and keep them.
So are we extending the deadline then for the tariffs for China? Then is that what's happening?
Actually, again, I don't think there's something firm about that either. So, at least not that I'm aware of. So, it's possible, but I don't think that something like that has actually been formally announced. So, I think it's very similar. It's very similar to the Brexit situation. There's talks and there's anticipation of something happening, but really nothing has happened yet. And as mentioning, now that I mentioned Brexit, we had the EU during the weekend. There were some headlines saying that they're mulling an extension of the deadline to 2021, so 2 years. But this gave the pound a little bit of a boost. But then the spokesperson for Prime Minister May said today that she doesn't see extending Article 50 as solving the issue. So no progress is being made, as far as I can see, apart from some, constructive comments so far.
Got it.
It's becoming a bit. Hey, Gregor.
Hey, Gregor. How you doing?
I'm fine, thank you.
Awesome. Well, thanks, Stelios, for the update, and I think that it is more hopium than anything in the markets right now, that they assume that they're gonna prolong they're gonna prolong the negotiations, and therefore we're working towards a common goal of settling some sort of trade dispute.
I agree.
So, Gregor, it's good to have you here. I know Steve is going to be. You're going to be having lunch with Steve tomorrow, right?
No, a dinner today.
Dinner today. Okay, so Steve.
Yeah, he's a little bit optimistic.
Yeah.
He's in the way here now, so he has around 800-900 kilometers, I think, for 7 hours.
Oh, geez. That's pretty optimistic, but he is on the way. So that's going to be pretty cool. We can't wait to see pictures of the two of you guys having dinner at 1 o'clock in the morning. I can't wait for that. Gregor, this has been a very challenging environment for most people because the volatility is so low in these majors. So what, we're hoping that we're going to get from you today is maybe a little bit of a clue in what we can look for. Should we get some directional, developments in this market? Because if the market starts to point us in, whether it's a dollar breakout or it's a dollar breakdown, we start to see some movement in the majors. Maybe you can help us with some of the counts as far as understanding where it could take us. Because, while the euro is trading below, or, between, let's just call it 112.50 and 113.70, which we're at the upper end of the range in the euro. And as everybody knows, we're just kind of hovering around this 38% retracement. We know that if we get a breakout, towards 114, that's going to be pretty bullish. We get a breakdown towards 112, it's going to be pretty bearish. But where could we go? I mean, where could we target? And I think that's, for those of us that are waiting for some sort of range break, I think that's what, we want to know. It's like, okay, well, if we do get a move, like let's say in the euro, we start trading towards 114, where could that take us? And I don't know if you're bullish or bearish the euro as a whole or the dollar as a whole, but kind of understanding what an Elliotician's take would be, I think will help us in general. So I'm going to pass you over the charts, and I'm going to be here, but I'd like to see what you're looking at.
Yeah, sure.
Okay, so I'm pushing the charts over to you.
Okay.
And like I said, I'm here as well. But yeah, let's see what you got.
Okay, so euro dollar longer term speaking, I mean, I'm still looking for nice move to the downside. We discussed last week with Dale and Steve that I'm looking at the commodity equality index, where I'm anticipating another leg to the downside. So I think that dollar may still see more gains, which means that euro dollar could come under pressure. But for the short-term charts, I mean, this is really just an ugly range since summer 2018. So I think that this is just still ongoing correction. Even if we see a spike below this November lows, I would still be aware of a bounce, because I'm tracking a flat correction here. So it's a 3-5 pattern. So wave C could lift prices much higher here before we see a real continuation lower that I'm expecting to unfold. So for now, I just think that euro dollar, even just temporary break to a new low, may not give us any clear direction, because it can be just a temporary spike down. I also see some wedge formation here on a smaller time frame that can be unfolding right now. Or this whole structure, this whole decline, if I give you another perspective, just a second.
Ending diagonal, buddy?
Yes, exactly. So even this can be an ending diagonal. Okay, and again, it suggests that from a new low, we may see a reversal. So if I just level this one really quick here, okay, this could be 3 or 4. This 5 should be here, and this would then be 5 subways within a wave 5. So no matter how I look at it, I just think that breakdown, any significant breakdown here, is not in my eyes, definitely not. And maybe this reason for such view can also come from dollar index, where I also expect wave C. So notice that I'm tracking wave 2 for higher degree, okay, and definitely if we are in a higher degree than a previous wave 4, which was what, 300 points, I want to see that this wave 2 will be longer or at least more complex than a wave 4, which was of a lower degree. So wave 2 can also retrace 38.2% still. There were plenty of interesting supports around this 94 level. So I'm still kind of expecting this dollar pullback actually, while the euro dollar could rally. So, but generally speaking, these are all big ranges that can still stay in play. Even if we see a move to the downside, you will see limited prices at the lower side of this range. So maybe we'll have to wait on a real breakout on a euro dollar or dollar index if you want in the second part of 2019. And as I said already last week, I just don't remember when it was last time I traded euro dollar, and probably I will stay on the sideline for a few more weeks, if not months.
Wow, that's a long time.
Yes, I mean, I don't have any clear perspective, because if I see just too many different wave counts, too many different options or scenarios possible, I just think it's better to stay aside and just track it from a distance and look for some clear patterns and set up on other markets.
Right. So if you're not seeing anything on the euro, how's the cable look for you? Because the cable.
I mean, it's the same.
Oh, it is. Okay. All right.
Yes. I mean, for the short term, you see, I just labeled this range.
Yeah.
I mean, we haven't seen any clear moves. I mean, this was a clear bearish move for 2018, but then we just simply are trading sideways. So I'm just curious if this wave 2 maybe already completed at this resistance, or from a psychological point of view, would definitely be much better for me to see a spike below this, above September 2018 levels before we see a reversal lower, because I'm sure there are plenty of stops above there, and maybe this will actually, based on timing around this Brexit, it could be a perfect scenario to see some volatility that could send prices to the upside and then maybe a reverse south in in upcoming weeks.
Yeah, yeah, we're just we're obviously very headline dependent at this point. So, how about some of the currencies that have been moving, like the Aussie has been grinding higher, the Kiwi's been grinding higher. So, is there any better views with some of the commodity currencies?
Yes, I mean, dollar against Mexican peso, probably this was one of the clearest that I have been tracking for a while. So, as you know, market has been here bearish since December of 2018, and this was quite a strong move down from that swing high. Okay, it was a very extended move. So typically, an extended moves in Elliott wave structures represents wave 3 in a 5-wave sequence. So if this was wave 3, then this was wave 1, wave 2. So we have seen a wave 4. And wave 4 also bounced back to the area of this small wave 4 that I labeled there. Not only that, we had a triangle here in the middle, which, as you know, gives me very important confidence that actually the whole structure was corrective, because triangles cannot occur in wave 2. So there is no way to label this as wave 1. Okay, just let me label this as a wave 1, this wave 2, and you would be expecting more upside, because triangles never occur in wave 2. So if it's not wave 2, then it can only be wave B, that is part of a complex, more deeper corrective bounce, which was wave 4. And not only that, we have seen a very nice reversal lower recently, definitely fall back into this triangle range, which gives a lot of overlapping price action. As you can see, very unidirectional move. So when I see this type of a price action, it suggests that we are still in downtrend, and that this was only a pause within this weakness that I'm tracking. So dollar Mexican peso, I think it can fall even lower, but be aware of pullbacks. I mean, crude oil just moved to the downside on Trump comments, I think. So
yeah, I sure did.
Yes, so crude oil will continue to weaken maybe today and tomorrow before the prices again will stabilize a little. I just think that dollar Mexican peso could, in the meantime, make a new pullback before we see a next leg to the downside. Because I think that crude oil, the upside is still not done. There is room for more gains for sure. But as always, pullbacks at this stage are definitely something totally normal. If you take a look at crude oil here, what I'm looking at is actually maybe for a flat, irregular correction in a wave B. Maybe even this could transform into some kind of a triangle if we stay in range. Or maybe wave B already finished correction here at 51.56. But in either case, after a pullback, I think that new leg to the upside could unfold. So this could obviously lift prices of Mexican as well against the US dollar.
Right, especially if we see a little bit deeper of a pullback in crude, right?
Yes, exactly.
So since you're talking about crude, and maybe we can discuss a couple other commodities like gold, because gold and silver have been extremely strong.
Yes, I mean gold. Gold made some very interesting reversal last week, as you know, at the end of the week. So we have actually seen a reversal from this upper side of the range. Okay, so what I'm thinking is that not that we will see any significant decline, but at least temporary weakness. We are also testing the 78.6% of the previous rise. So this is the last fib levels that I would pay attention to, which may hold at least for a pullback here. But the most interesting is on the 4-hour chart is that this reversal came after these 5 waves up to a new high. And the most important is that this was a very strong move. Okay, so it was a very strong break to the upside after a push above this January 31st highs. So it was accelerating move, but bulls were not able to stay there. They were completely erased even more by the end of the week. So to me, this is an evidence that this was just a temporary breakout and that we are going lower. And this, in Elliott wave terminology, should unfold in at least 3 waves. So this was either wave 1 or wave A, wave 2B. So expecting a drop into wave 3, maybe just only wave C. Okay, so I'm definitely expecting here a reversal. Here's also this candlestick formation and just basic technical analysis. I mean, we have a wedge here. We reverse the upper side of the wedge. We see this evening star formation. Okay, we have divergence on the RSI. So we have also these indicators that suggest another leg down as well, which can confirm the Elliott wave count as I'm using this.
Okay, so you know a little bit of a continued pullback in gold, and that could also boost the dollar and have and maybe have the euro pull back towards 113.
I mean, yes, but gold and euro dollar were really just not linked a lot since start of the year. So I'm really curious when this strong correlation will come back, because as you know, gold made a very nice extended move to the upside since start of the year, while the euro dollar, I believe, is even negative for the year. So,
yeah, that's a great point, that the correlations are not as strong as they've had in the past.
But I know that traders are trying to trade them based on those correlations. But if you're an intraday trader, I'm not really sure how much this can help us at this stage when correlations are not there.
Right. That makes sense.
Yes.
What other? Oh, go ahead.
If I may interrupt for just 1 second, I have been out all day today, but there were a few friends of ours who actually did point out that Trump did actually announce an extension to the tariffs. He did say last week that if there's progress made in the talks, we will consider making an extension. But he actually did tweet it today. So sorry, I wasn't aware of the actual tweet, but apparently this is what's happened this morning.
Well, and that's one of the, that's the factor that's keeping stocks at the highs, and CTA and the CTAs are pretty much max long in the market. Hedge funds have to chase yields higher because most hedge funds are continuously underperforming the S&P, which is just going to keep a natural bid in equities, at least near term. So, yeah, thank you very much.
I mean, the equities here, as you can see, probably you covered this as well. When you cover the S&P, I mean, this is a very important resistance that we are now approaching here. Also, we are moving higher on Monday, which I typically do not trust much. Normally, if we see a very important or sharp moves on Mondays, they can be reversed, at least in the second part of the week, if not earlier. So I would not be surprised if maybe we see some kind of a reversal down from this resistance. And from an Elliott wave perspective, we definitely are at the levels or at the stage where bulls should slow down, at least for
kindred spirits on that philosophy, Grega, about starting sharply higher or lower on a Monday for a potential reversal week. So, yeah, I have one question. I have one question. What do you make out of what happened to crypto last night?
Crypto, yes. Just let me open. I'm sure Blake is also interested to see.
Yeah, I know. Blake,
of course, I always am. Always am.
I wonder if Steve is still in Ethereum or not.
Yes.
Good question.
He's in a Mercedes.
Yes.
I don't think Ethereum has enough horsepower for him anymore.
He booked profits from cryptos on Friday.
Yeah.
So he can afford it.
Nice. Yeah.
I mean, Bitcoin, as you asked, we have seen a very sharp reversal this weekend. Actually, if you are tracking futures, you won't see this spike higher, which actually occurred on Saturday, I believe, right? So So it's very important reversal at the moment, which I think has room for more weakness. As you know, we are obviously in a new stage of a pullback. So even if this is bullish or bearish on the longer term scale, I mean, we have to see firstly a free wave drop, and then we will see how the price action will actually unfold from there. But 61.8% down to 78.6% is definitely interesting region, because it also comes in around these former wave 4 levels. So, but
thank you, bro.
Probably more weakness after this minor bounce will be the next thing.
And it's possibly a wave 2. And if we get a wave 3, are you looking for like 1.618 of 1? That, and what kind of levels could that take you to?
I mean, this will be such extended target for Bitcoin that I'm actually scared to call them. I mean, because calling
I know.
Any
6,900. How about 6,900 for wave 3?
6,900. Yeah, that would be possible, but still, I mean, we have to see break out of the range. As you can see, it's actually some kind of even range. So let's firstly see how this ABC unfolds, or I should say only free wave decline, and then we go from there.
Good luck. Thank you, Grega. I've learned so much from you, man, in the last couple of years. Really have. So if I have, I know I'm not the only one. Really appreciate your work. And from Blake and from Steve, all you guys I've learned a lot from. So
experience as well, for sure.
Thank you, Grega. So I no, go ahead.
I also wanted to cover, as I mentioned to Blake, that I'm looking at the S&P 500 trading into this resistance. So maybe yen crosses can be interesting this week. I mean, I'm looking at this triangle that is unfolding on treasuries. So new leg to the upside here, if it occurs, obviously will help this resistance to hold on the S&P 500. So I will be expecting then a pullback here as the 10-year US yields would move south while these notes prices are on the rise. So if we go from there and look at some crosses, maybe we can look at what we have here. Aussie yen, CAD yen. Let me check. On CAD yen, what I'm tracking here and thinking that maybe we are going to see this reversal to the downside for a wave C. It's also some kind of a small wedge, which could also help us to predict the next leg lower, or at least limited upside. So I don't see any significant rise here. It's just some kind of a slow move. So I would not be surprised if this is actually a part of this potential flat correction for a wave B. Okay. So I would be looking for limited upside here, especially if this on stocks and the S&P 500, and on the 10-year US Treasuries will play out. Also here on the right, on the daily chart of CAD yen, you can see that we have 100 and 200 simple moving averages that can hold as a resistance as well. So I would be looking for potential reversal down. Let me check the Kiwi. Here's also possible flat. I see some gap here in a smaller time frame chart. Okay, so actually this, to give you a better perspective, this is A, B, C. see. Okay.
Okay.
Let me remove these trend lines. Okay, so we are now tracking and the final stages of a wave B. We have seen a 61.8%. Of course, there is possibility to see an extension towards 100%, which is equality level of the first leg here. Okay, so the gap here that is open below, I mean, it will probably be filled. So watch out for potential failure breakout here and a reversal lower. And if stocks would really show us this bearish turn, then this would just confirm or send or put a high in for this pair as well, I think.
Okay, nice look, and it was right back at the bottom of previous major support, and yeah, that one shot you showed.
And also, what I wanted to highlight is that dollar yen, which is normally very important for those yen crosses. I mean, dollar yen is struggling here, despite very nice move to the upside on stocks. So when stocks hits resistance, I think this one can be very quickly at the new swing low, which would obviously put some downside pressure on those crosses as well.
Wouldn't that also push yields lower, Grega? A move like that? Say a correction in the stock market, decline in U.S. dollar yen.
Yes.
Yeah.
While the 10-year U.S. notes prices would rise, yes, out from that triangle.
Okay.
So yes.
Oh, I see. All right. Nice. Yeah. Okay, buddy. What a great presentation. Anything you want to wrap it with?
Yes. So just stay aside on euro dollar, stay aside on ruble, and pay attention to clear patterns, directional moves such as dollar Mexican pesos, such as maybe, and that's it.
Okay. All right. Well, you know, everyone listening, you have a chance to meet Grega this weekend in New York. He's taken the time to leave his country to fly across the pond to be there with Steve and Joe and maybe Blake. So, Greg, I hope you have a great trip. If I don't talk to you, have a great trip to New York. And
yeah, thank you. I'm leaving on Tuesday. Yes, I'm leaving on Tuesday, actually a few days earlier. So I take advantage of the trip.
Okay. All right. Well, you know, I have some bodyguards waiting for you there to fight off the women that'll be attacking you. Okay, bro? So you're safe. Tell your wife you're okay. And have a great time.
Thank you, man. Thank you. I will definitely join the webinar still. So
okay.
Okay. Thank you.
All right, Grega. Thank you. That's Grega. You can find Grega here with his research and on Twitter at Grega Horvat. And I see my trading warrior brother Jim Welsh is here. Hi, Jim. I'm going to make you the presenter and make sure that your phone is working. Really looking forward to talking to you. We gave you a big build up. Are you there, bro? Let me see. Okay. I just unmuted you.
My wife has been trying to do that for a very long time. Maybe it's the opposite.
Yeah. Yeah. Well, keep trying, Heidi. Anyway, buddy. Okay. Great to have you with us, Jim. You know, the market keeps moving. We were talking about the dollar. I know you have a lot of things that you want to talk to us about. So, and you brought us a nice PowerPoint, and why don't we just get the show on the road and talk about really great calls you made in the fall for the decline in S&Ps, and also after gutting out gold going to 1160, you know, it rewarded you. Nice call there, and I'm interested in what you're thinking in the dollar as well, because that's our bailiwick. So take it away, buddy.
Of course. All right. Well, thank you. Thank you for all those who are listening, and I appreciate it. I will do my best to make this time that you're spending with Dale and I of value. One point I would make is that I know that the focus, and Dale, please correct me if I'm wrong, but the focus is really fairly short term in most instances in terms of trading Forex and so forth. I understand and appreciate that short-term nature, but it's kind of like the forest from the trees. I think if one has a skill set to trade markets on a short-term basis, that's a great skill set to have in terms of measuring and limiting risk and managing risk properly. But I also think that it can be, of real value if you also, over time, develop a skill set that is able to kind of identify more intermediate or longer term turning points, not just in currencies, but in markets in general. And what we're going to talk about this morning.
Get used to it. I'll probably interrupt you a few times today, but it makes me think. Okay, it makes me think. Everyone says, "Oh, great call, great trade," but you know what is the toughest thing to do? Have a great hold.
Yes.
Okay, I mean that's my weakness anyway. I'm sure it's others.
Well, I think it's a lot of people, and I think it's a natural, result of when you're really focused on short term in nature, and you're glad you picked out 200 bips or whatever it is, and you're patting yourself on the back, and then the market moves 1,000 pips or whatever. And the old saying is cut your losses, but let your profits run. And I think in order to have the conviction needed to let your profits run, or at least have part of your original position, you let it run, is to, again, stand back and be able to have a skill set that allows you to identify intermediate turning points in various markets. So that's kind of what we're going to talk about very quickly. One of the things, listening to CNBC, and I'm sure anybody who listens to either Bloomberg or CNBC, hardly a day goes by where there isn't at least one person who says that markets are a discounting mechanism. They're telling us something about the future. If we listen to the markets, they'll tell us something, so on and so forth. And the point I would make is the most important thing that markets can do is help us when things are changing. And, at the same time, people aren't stupid. So the reason why this idea that markets are a discounting mechanism, just doesn't happen just because. There are reasons for it, but it's important to understand those reasons so that at turning points, people can learn to gradually detach. And what happens is during the bulk of a move, let's say the mid 60 to 70% of a large trend move that may last months and months, the fundamentals are aligned with the trend in prices. So, in terms of the stock market, the economy's doing good. The Fed isn't going to continue to raise rates, or hasn't raised rates, as was the case for about 8 years. Earnings are growing. The trend is up. Yeah, you get little setbacks,
but they weren't. That wasn't the narrative at the end of the year. So the market was wrong. So there's one of your examples, right, Jim? That the market in December was discounting a recession, and now the market up here is discounting a great economy.
Well, again, I'm going to pull back from the idea. That's what people will tell us. But I'll go back to some of the examples on the first slide that I had. In 2007, all the averages made new all-time highs, which, according to the theory that the market is a discounting mechanism, was basically telling us we had nothing to worry about over the next 6 to 12 months. And of course, we all know what happened. A financial crisis happened within 12 months. When gold was at 1920, there were a lot of people really believing hyperinflation was right at the corner, and yet the Fed has continued since 2011, doing everything they can to get inflation up to 2% and keep it there. House prices. So my point is, this concept of discounting mechanism is not applicable just for the stock market, currencies. It's everything. In housing being another example. And as I said, as you pointed out, Dale, in the fourth quarter, oil prices went down, yields on treasuries, dropped significantly. And everybody inferred from that, my goodness, these markets are all collectively telling us something about the economy, which is not good. And so people are conditioned. You keep hearing this day after day that the markets are a discounting mechanism. And as I said, for 60, 70% of the time, it seems like it's, yes, of course, look at the market's going up, the economy's good. Market's going to hell in a handbasket, it's good. The dollar is strong because of this, this, and this, and that's going to continue. And that's the other thing, just as human beings, we all have reason, logic, and the things that kind of seduce us are when we start to understand why markets have been moving in a specific direction. It's very logical. We understand it, but understand what's happening is as people gradually understand the reasons, they're putting their money to work, whether it's in going long the dollar, short the dollar, or any other market. So I believe that at turning points, the concept of discounting mechanism is completely wrong. I mean, at every single top in every single market and bottom, the market is wrong. Think about that for a while. Every market is always wrong at the turning point. Why? Well, because at the tops, the majority of people have already committed their money, and at the bottoms, they pulled their money out. So contrary opinion, to me, is way more valuable and helpful than the concept of markets being a discounting mechanism. But it is really, really hard to do. Because
right. So, yeah. So I'm usually early, Jim. How do you overcome that? By piecing in with partial positions?
Well, a couple things. It's a great question. To me, first of all, you got to identify when you're at a point of contrary opinion where it might begin to be applicable, and that's where positioning can be very helpful. But understand, yes, but that sentiment usually happens before the turn. In other words, people get really excited or very, very negative, and the market is still going up or down. So sentiment is early. So the next thing that has to fall into place are technical analysis in terms of seeing RSI divergences, trend lines being broken to the upside or the downside. And that's what tells you that, all right, the cracks are starting to really form. If there were 90% bulls and one person decides to sell, now you only have 80% bulls. Another person decides to sell, then 70. And at some point in time, when everyone is overly positioned in a, whether it be oil or, a currency, as slowly but surely some of the sellers start to come in, it does impact the technicals and it starts to show up in that way. But to have that conviction, to be able to put a position on, and you're right, scaling in is one of the ways to kind of help manage risk. And when the technicals fall in line, you jump on, more aggressively. But if you have this conviction that, gee, sentiment is so extreme and it's going to take weeks and months to unwind this, be able to hang with the position. So we're going to look at some very, I think, very helpful tools. Now, one thing I will say, the Commitment of Traders report comes out every Friday afternoon at 1 o'clock Pacific Standard Time. Because of the government shutdown, the Department of Agriculture was still receiving all the data, but they're now trying to play catch up. So now what they're doing is every Friday afternoon and after the close on Tuesdays, they're catching up. So right now, there's
it looks like they're about. Yeah, I could see that the line's in, and that you still have some bars there without the lines getting there.
Came out on Friday was as of February 5th. So the data that they post is always through the Tuesday on that, and then followed on that Friday. So, but
isn't it great to have like all you have is a rear view mirror on the COT now for a little while?
But yeah, but fortunately, the objects in the mirror are starting to look smaller or something because they catch up or something. So in a few weeks, they will be caught up. But for the benefit of our conversation this morning, we're talking about contrary opinion, identifying positioning as being one of the elements as a forewarner that, all right, there's too many people who are bullish or bearish. When the turn comes, it's going to be big. So what we can do, the middle panel shows large specs, small specs, which are trend followers, hedge funds. The bottom pattern, well, I'm not going to do this on the bottom because it's different people. Yeah. Commercials typically take the opposite side of large specs, small specs. So what we can see is bond prices as they were unraveling from September of 2017, all the way down as we got into October and November of this year. The large specs got more and more short, so that they were short, I think, in October, 750,000 contracts. This is just in the 10-year. If you look at 7-year, the 5-year, the long bond, across the board, huge short positions. What this suggested, at least to me, was they were so short that if the news changed and bond prices had a reason to start to rally, these guys were going to get run over. So what we saw was the 30 or the 10-year go from 3.25 down to 255 a few weeks ago. And of course, people are looking at this as saying, oh my goodness, the bond market's telling us something really bad's going on in the economy. If we look at oil, what we can see is the opposite in terms of, for a year or more, oil was just grinding higher. As a result, large speculators, small speculators, trend followers jumping on the bandwagon. All right, the commercials taking the other side of the equation. So again, you can see the peak and the extremes of these things kind of happened in March to May of 2018. This goes back to the technicals. Basic, just drawing trend lines on this chart. You can see that once it took out 66 or so, the trend was down. What added to this was on November 5th, Trump had talked about imposing sanctions against Iran. And when it came push to shove, he said, no, I'm going to give exemptions to everybody. That was on November 5th. Oil was trading at $64. Within a few weeks, it went down to under 50. At the same time, there was a huge short position in natural gas. So people were long, the hedge funds were long oil, short natural gas, because for years, the oversupply, it didn't do anything. It just went sideways. So what happened is in the first 2 weeks of November, definitely given a huge shove by what Trump decided to do, natural gas prices rallied by 50%. Oil went down 13 days in a row. Clearly, this is a result of over positioning. But the conclusion, because markets are a discounting mechanism, was that, oh my God, oil going from 75 under 50, it must be telling us something about the economy that ain't good. So the point being here is people were looking at what the markets are doing. And since they have this, I think, wrong view about markets being discounting mechanism, without looking at positioning and the role it played in the sell-offs in oil and the drop in treasury bonds, it led them to the wrong conclusion. The last piece was the FANG stocks, the 6 stocks represented by FANG, Apple, Amazon, Facebook, Microsoft, Netflix, and Google. 15% of the S&P, their weighting was more than 290 of the lowest stocks. So one of the final, Apple was like the last man standing. If you looked at a chart of Apple, you saw the 215 was really important. It broke it. And once Apple broke, it was like the dam broke. And that unleashed a lot of selling. So thinking about from a positioning standpoint, you have hedge funds that are long oil, short natural gas, they're short bonds, and the long FANG stocks. And all of a sudden, in a very compressed period of time, they're getting margin calls all over the place. You start to sell what you can. And to me, one of those things was, I'm selling all the FANG stocks. And that's why, back in, I thought during September that the underpinnings of the market was getting weaker and weaker as the S&P made a new all-time high on September 21st. Less than 50% of the stocks were above their 200-day average. The last time that happened was in July of 2015, right before the S&P broke 15%. So,
Jim, back then, you know what they were saying near the tail end of this rally? I heard on CNBC that investors are buying the FANG stocks as a flight to quality trade.
Absolutely, and for hedge funds, if you didn't have heavy weighting, but that's what your point is. That's how crazy it gets at the end.
That's what I mean. Flight to quality means like the TED spread to me.
Yeah, they're safe. In the early 70s, there was a thing called the Nifty 50, and it was like these are one decision stocks. All I got to do is buy these 50, and I'm home free. The same thing was kind of happening where as these stocks succeeded, it drew more money. The other thing is with the rise of passive ETFs, as money get put into the S&P and other ETFs, money automatically gets allocated to these stocks. So the weighting also got bigger because of those reasons. So this all kind of all came together, and the calendar probably played a role because going into December, a lot of people saw, oh my God, my year is going away. All right, so now we're going to up to date, since we got old commitment of traders data, gold. I think one of the potential patterns in gold is after dropping from 1920 to about 1040 in December of 2015, gold rallied $330 some up to 1375 in July of 2016. I think that this is, in a sense, a retracement rally of the decline from 1920 to 1040. $880, 50% retracement, targets somewhere around 1480, give or take. So in my opinion, this initial rally off the low at 1040 is wave A of a much bigger ABC. Now, the B wave normally is an ABC, A down, B up, C to a lower low. So what gold has been doing is, in my opinion, potentially tracing out a triangle. So the decline from the high in July of 2016 to 1122 in December of 2016 was wave A. The rally up to last January of 2018 at 1365 was B. The decline to last August at 1160 was C. I think we may have finished wave D of this triangle last week. What that implies is a wave E decline that, in my opinion, has a shot of getting down below 1220. Wave A of the triangle retraced
1220 is GLD, right, Steve? Right, Jim? GLD.
That's gold, and this is GLD. Is I'm using it as a proxy just because I could show all the labels and it's easier for me to present it. But
it's at a discount to gold futures and gold bullion, right? I mean, gold bullion trades higher than GLD, doesn't it?
Premium. I mean, they're not matched up perfectly for various reasons. But the form, if you look at a price chart of gold, you'll see this pattern. I'm referencing obviously gold prices as opposed to the prices of GLD on this pattern. But if you look at gold, you'll see if you compare them. Okay, I'm sorry. I'm glad you caught that. I should mention that. All right.
Okay.
So wave E, if this triangle is correct, should pull back, I think, 70 to 80%, because wave A of the triangle was 77% of the preceding wave. Wave C was 83% of the preceding wave. So if we take an average, 80%, it would actually get us down towards gold to about 1200. After that low is made, and wave E should be a down, up, down process. After that ends, again, what I'd be looking for is, the large specs have turned negative. Positioning maybe have gotten short. And it sets the framework for a rally up towards 1480 to 1525. So once this triangle ends, there should be a very powerful rally that carries gold up fairly significantly. The alternate count is that, again, wave A up to the July of 2016. Then you had an ABC, kind of a flat to the low of last 1160. This rally now is wave one of wave C. You're still going to get a pullback. It probably be more shallow than wave E. It might only retrace 382, which would be about $70. Maybe you pull back to 1250, 1270. But either way, gold should pull back. And one of the things I'll be looking at is sentiment and positioning. In terms of the dollar, last March, April. Well, let me back up a second. Back in January of 2017, there were 90% bulls. The positioning in the dollar was lopsidedly bullish. Why? Because everyone knew the Fed was going to be raising rates in 2017. And don't you know, when rates go up, that means the dollar has to go up. Wrong. Because in 2017, the Fed raised rates 3 times. They raised them again in March of 2018, and the dollar went from 103 to 88 and a quarter. So again, these are one of the things as far as, it sounds so logical and it makes sense. Higher interest rates ought to cause a currency to go up. It's hogwash. it kind of seems like it should make sense. It didn't work, obviously, in this case. We turn forward to February, March of 2018. Sentiment 10% bulls. The positioning had slipped significantly, you know, from being overly bullish and positioned long in January 2017. The positioning now was then short. To me, it suggested that at a minimum, the dollar would rally to 95, which was a retracement of the decline from 103.80 down to 88 and a quarter. We can see it's 5 waves up, or certainly looks like 5 waves up. That implies that potentially down the road there can be even more strength. In the short run, I believe the move from 97.70 down to 90. Let me back up. 5 ended in September of last year. We had a pullback to 94. The dollar ran up to 97.70. I think it did a 3-wave down for A, B up to 97.70, and I think ultimately, at a minimum, the dollar is going to pull back to 95. And I think more likely down to 94. And that'll be the moment of truth in terms of what happens. Right now, currently, you know, the positioning is still quite long, the metal or the dollar. So that suggests we're going to see a decline. Looking at the euro, a week ago, there was 10% bulls on the euro. I get it. You got Brexit overhanging. You got stuff going on with Italy. It's in a recession. France pulled its ambassador to Italy for the first time since World War II because Italy welcomed one of the members of the Yellow Jacket movement, had, you know, pictures taken, posted on Twitter and Instagram. They got upset, you know, in terms of it. So you've got a lot of discord going on. But with 10% bulls in the euro, positioning is very short in the euro. To me, we're at the point where you got to look for a place to go long. So whether the low is already in, I think there's a rally back towards 117 to 118 that's coming over the next several months. So there may be one more new low, you know, because the way it's rebounded, you had a key reversal day one day last week. The follow through has been not terrific. So I think potentially, yeah, but again, the positioning and sentiment suggests looking at the long side. And again, this is where overlaying the tools that Dale, your listeners and the people who get so much value out of these meetings that you have and the people you suggest, you know, they have their short-term tools. This is the time where potentially those short-term tools can really help identify what could be a pretty nice turning point. So this is just one thing. I do both fundamental and technical. You kind of gather maybe by some of my comments. In December, when the market was falling apart, people were worried about recession, believing that the drop in oil, the collapse in bond yields, what was going on in the stock market was telling them, oh my God, we're headed to a recession. The Fed's going to keep raising rates until it pushes us into recession. Kramer, who I really kind of like and respect, I think he does more good than bad, but I thought he was off the reservation because he said, yeah, Jay Powell smiles. He wants the unemployment rate to go up and he wants everybody to be shopping at the dollar store. Sorry, Jim, that's you're getting carried away, pal. So to me, it just came down to listen to it. Yeah, booyah. No, if you listen to what the Fed members say in their speeches, and most people don't, by the way, which is amazing, it was obvious that the Fed wanted to get the Fed funds rate up to near neutral. There's no mathematical equation that tells them what neutral precisely is, but they wanted to get it up near neutral. They wanted to see, okay, the slowdown that's happening around the world, and we forecast a slowdown in 2019. The Fed in September and December put out their projections for GDP, and they dropped them to 2.3% from 2.5%. So the Fed was anticipating the economy slowing down. So to me, everything lined up. The Fed is at pause. They're going to wait a while. And yet, in my monthly macro tides, I wrote, here are the reasons why the Fed is going to be pausing. 3 days later, Jay Powell gets on TV, talks about it, and it's like, woo, wow, what a surprise. And then during January, 5 different Fed FOMC members all gave speeches, including Esther George, who is the most hawkish of all of them. And she's talking about it's time to be patient. We can wait. So again, to me, it's amazing
Hey, Jim, let me ask you this. What was your impression when you saw Powell sitting there with Yellen and Bernanke around the same time frame? What do you think that was about? To send a dovish message out to the world with two of the biggest doves ever?
Well, that was, again, that was organized months in advance, Dale. So,
okay.
Okay, so
no theater. There was no theater. It was, it was a planned get together. Okay.
Planned get together. Now, at the same time, it happened to be timely in the sense of giving him a platform to reiterate again. And December 19th, after the markets, went to hell in a handbasket, he said, monetary policy is not on a preset course. He said it. Then on January 4th, policy is not on a preset course. So it's amazing. On December 19th, no one listened to that part of it. On January 4th, it's like, oh my goodness, policy is on a preset course. That means the Fed may not be raising rates. It's amazing. And then on January 30th, after the meeting, they included the word patient. What a revelation. Hey, for a month, all these people have been out there talking about patience, including the most hawkish person. So, again, this is, the advantage of kind of paying attention and looking at fundamentals and, to me, again, not falling for the idea that markets are a discounting mechanism. It provides one a perspective, forest from the trees, to be able to catch some of these major turning points. So then you can overlay the skill set that the people in this room and that listen to these kind of discussions can really implement and pinpoint a turning point, maybe within 1% of a bottom that's going to be followed by a 5 to 10% move. So again, I would just suggest that, working toward the goal of trying to have the tools in place so that you can have the conviction, as Dale said, letting a trade run, letting your profits run, even if it's only 25% of a normal position, I think obviously has the potential of really increasing one's profitability in the course of a year. And when you look at a number of these markets, these turning points happen once or twice a year. So if you're following a number of markets, you have the potential of 5 or 6 times in the course of a year of catching a really big move instead of little snippets of a big move. And that's why I think it's a value to pay attention to positioning and slowly but surely develop the mindset of contrary opinion. I'm going to do one off the line story, but how this stuff can be applied. In the late 90s, going into the dot-com bubble, cigar smoking was huge. Now, Dale and I are in California, right? And they actually had restaurants out here that had smoking rooms. So you could go there, pick out a nice cigar, have a cocktail or two, have a cigar, all right? And this became a big deal. And some of the cigar companies, they'd come and they'd give away cigars. You can have 1 or 2 of like 4 or 5 different companies. I mean, it's like the heyday of cigar smoking, right? One day every Saturday, I would go to the local 7-Eleven to pick up Barron's. This is before they would drop it on your driveway, right? So I wanted to get Barron's fresh on Saturday morning. I walk into the local 7-Eleven, and on the counter is this little box full of cigars. And I went home to my wife and I said, Heidi, the cigar craze has peaked. Because if it at the point in time that you're going to go from nice restaurants having smoking rooms, the guys giving away cigars, to the point of it's on the counter at 7-Eleven next to being able to buy a lottery ticket, the trend is just about over. And honestly, that was pretty much
I'm waiting after if we get this pullback you're talking about in the dollar. I'm waiting for a McDonald's commercial where they go, the dollar is down. Remember that one? That was pretty close to it.
The bottom two.
But you can still get a burger for $1, but the dollar is down.
Exactly. In other words, there's magazine covers, there's clues out there in the world. When a trend is truly mature, it starts to show up in the press and on TV. But if you don't have the mindset of thinking along contrary opinion, that stuff just flies over your head, goes right by you. You don't see it. So I'm saying it's difficult to do. but as one develops the sense for contrary opinion, looking for those signs and signals, believe me, they are there. And then when you layer in your technical skill set in terms of identifying trend changes and so forth, it's a great thing to match up together.
Wow, Jim, what a great interview. What's most obvious is obviously wrong, Joe Granville. March issue. Yeah, March issue of Macro Tides. You're offering it free to people that see this now or later. That I really recommend you guys check it out and check out at least that free issue. I've been reading Jim's stuff for decades. I've learned plenty from it. Smart Portfolios LLC, registered investment advisor.
It is. It is.
Okay.
So,
and they use your stuff to money. Okay. So you accept what's the minimum account that you accept at Smart Portfolios?
If they mention this broadcast, we'll drop it from 100 to 50 just to get people's toe in the water. And then one thing I want to say, Dale, just to clarify, Macro Tides, the monthly piece is looking at the fundamental side of the equation. Okay. And this month, there's going to be a section in there talking about the rise of socialism in the United States, AOC, and I'm not passing judgment, right or wrong, but the point is that that is a movement. And what's interesting is if you look at the millennials and the Gen Zs, they are much more open to socialism and so forth. So over the next
your kids, are your daughters wearing white and walking around North County, man? Like the Congresswoman?
No, I hope not. I hope not. I see them often. Believe me, if I need to, I will have a conversation. My point is that over the next 10, 15 years, as millennials really move into positions of power in their 50s, they're the ones running the government. So it's easy to dismiss AOC and the Green New Deal. And my point is you can't, because what's happening is, just demographics. These folks are going to take over. And the last thing I'm going to leave you is in 1780, we had, the revolution. We all came together, the Americans that were here at the time, to fight Britain for our independence. 1860, 80 years later, instead, the fighting was between us. We had the Civil War. 80 years later, 1940s, was, again, bringing us together, fighting a common enemy in terms of Germany and Japan. Go 80 years later, it's 2020. Here we are. And the divisiveness that we see within the United States, the polarization, the lack of listening between both groups, the liberals and conservatives, to me is leading to something where again, we're fighting with each other. There is no common enemy, and it's
no world wars, no civil wars.
Right. Just the rule of alternation in terms of 1780. Bringing us together, 1940, bringing us together, 1860, fighting among ourselves, and now here we are coming into 2020.
That's interesting, Jim, because a lot of stargazers and astro traders that I talk to, they're saying the same thing. Don't worry about a world war; it's going to be internal strife everywhere.
Yeah, we'll just listen to TV anytime. So my point is, this month's issue on Macro Tides, there's going to be a section about this, which is a little bit atypical, but it's something that I think is timely. The weekly technical review is about 90% just charts and momentum and technical analysis. So just, for information purposes, if you reach the March Macro Tides and think, oh my God, this is not going to help me trade currencies, you got to understand, I'm looking at the bigger picture. At some point in time, as these things evolve, I suspect the dollar could become quite vulnerable, But that's that's down the road a piece, right? So
right.
Again, thank you.
Okay, well, Jim, you're welcome, buddy. Thank you for edifying Face again, my trading warrior brother, and may winning trades rain down on you and your company. And I really appreciate your work. It really is an important part of my intelligence gathering. Thank you for making me better in the markets and giving me views that not only serve me but serve people I'm in contact with. So good hunting, brother.
Thank you, Dale. Thank you for the kind words. and good health. And thank you, everyone, for taking the time out of the day to tune in.
And you could find Jim on Twitter at Welsh Money Management. Is that correct? Welsh Macro. Jim Welsh Macro. Oh yeah, it's right there. You see his Twitter handle there. Take a screenshot so you have his email address and check out the March issue. And with that being said, everyone, have a great day. Remember, don't just count your pips, count your blessings. And I'll see everyone for Turnaround Tuesday tomorrow. You're very welcome. Okay, thank you very much. Adios. Scott Henderson appreciates your work. Thank you, Jim.
Thank you.
Talk to you soon. All right, bro.